There is a particular kind of investor who does everything right and still loses. He reads the reports. He understands the balance sheets. He knows the history. He can recite every principle from every investment book ever published. And yet, at the precise moment when all of that knowledge is supposed to matter most, when the market is collapsing around him, when his portfolio is down 30%, when the headlines are screaming catastrophe, he sells. He sells at exactly the wrong time. And the reason has nothing to do with what he knows. It has everything to do with what he feels. In this memo, I want to examine something that I believe is the single greatest structural flaw in the way most people approach investing. Not their stock picking methodology, not their asset allocation, not their tax strategy. The flaw is emotional, and because it is emotional, it is invisible to the people who suffer from it most. I want to talk about fear specifically, the way that fear masquerades as prudence, dresses itself up in the language of discipline and caution, and then systematically destroys the long-term outcomes of otherwise intelligent people. I want to talk about what I call the emotion trap, and I want to give you the framework to escape it, not by suppressing what you feel, but by understanding precisely when your feelings are lying to you. Let us begin at the beginning. Human beings did not evolve to be investors. This is not an insult. It is a biological fact worth taking seriously. For most of our evolutionary history, the threats we faced were immediate, physical, and binary. Something was either trying to kill you or it was not. The emotional response that kept your ancestors alive, the rapid, instinctive surge of fear that triggered retreat, was not a cognitive error. It was the correct response to a lion. The problem is that financial markets are not lions. The danger they represent is slow, probabilistic, and deeply counterintuitive. A falling stock price does not mean the underlying value of the business has fallen by the same amount. A frightening headline does not mean the long-term trajectory of the economy has changed. The sensation of danger, however, is neurologically identical whether the threat is real or manufactured by a 24-hour news cycle. Your amygdala cannot tell the difference between a predator in the grass and a CNBC ticker moving in the wrong direction. Both register as threat, both trigger the same ancient machinery, and here is what makes this so difficult to overcome. The machinery is fast. By the time your rational mind has had a chance to evaluate the situation, your emotional brain has already reached a verdict. It has already labeled the environment as dangerous. It has already begun preparing the body and the mind for retreat. The analytical faculty does not get an equal vote. It gets a delayed vote in a room where the decision has already been made. This is the first loop of the emotion trap, the misidentification loop. The emotional signal says danger. The mind interprets that signal as information. And the investor acts on what feels like insight, but is actually evolutionary noise. I have watched this loop play out in every market cycle I have witnessed across 5 decades. I watched it in the early 1970s when inflation made investors feel that equities were permanently broken. I watched it in 1987 when a single trading day produced losses that felt like the end of capitalism itself. And then the market recovered completely within 2 years. I watched it in 2002 when the dot-com wreckage convinced a generation that technology companies were uninvestable. I watched it in 2008 and 2009 when fear reached a pitch so intense that rational people were seriously asking whether the entire financial system would survive. And in every single one of those moments, the investors who acted on their fear, who sold, who retreated, who moved to cash, did not protect themselves. They crystallized their losses and then sat on the sideline while the recovery happened without them. The pattern is not accidental. It is structural. And understanding why requires us to go one level deeper. Most people think that risk is the probability of something bad happening. This is the surface level definition. The textbooks will tell you that risk equals volatility, the standard deviation of returns. I have spent decades arguing that this definition is not only incomplete, but actively misleading. Volatility is not risk. Volatility is the sensation of risk. It is what risk feels like in the short term. The actual risk, the risk that should keep an investor awake at night, is the permanent impairment of capital, the loss that does not come back. Here is the perverse truth that follows from this distinction. The investments that feel the most dangerous are often the least dangerous. And the investments that feel the safest are frequently the most dangerous of all. Let me show you what I mean. In March of 2009, the S&P 500 had fallen approximately 57% from its 2007 peak. The unemployment rate was approaching 10%. Banks were failing. Governments around the world were debating whether the financial infrastructure of the modern economy could hold together. By every emotional measure available, this was the most frightening investment environment in living memory. And yet, an investor who put $100,000 into a broad index fund at that exact moment of maximum terror, that precise week in early March 2009, when despair was essentially universal, would have watched that investment grow to over $700,000 by the early 2020s. The moment of maximum fear was, in hindsight, the moment of maximum opportunity. Now consider the opposite. In early 2007, credit markets were calm, spreads were tight, leverage was abundant. Asset prices across almost every category were elevated. More importantly, the emotional environment was one of confidence, even complacency. It did not feel dangerous. Nothing felt dangerous. And precisely because nothing felt dangerous, investors were taking on extraordinary amounts of risk, borrowing heavily, buying complex instruments they did not fully understand, extending themselves in ways that would prove catastrophic within 18 months. This is what I call the comfort trap. And it is the second loop inside the larger emotion trap. When the environment feels safe, we assume it is safe. When it feels dangerous, we assume it is dangerous. But the emotional temperature of a market and the actual risk embedded in that market move in exactly opposite directions. Markets become riskier as they become more comfortable. They become less risky as they become more frightening. The great irony of investing is that the moments when you most want to sell are often the moments you should be buying. And the moments when you most want to buy, when everyone around you is buying, when the cocktail party conversations are all about returns, when a taxi driver gives you a stock tip with the unearned confidence of a man who has never been wrong, those are frequently the moments of greatest embedded risk. Understanding this intellectually is one thing. Acting on it is another. And the gap between those two things is where most investors spend their entire financial lives. I want to introduce a concept I think of as the consensus cost. Every price in a market reflects the aggregate beliefs and emotions of every participant buying and selling at that moment. The price is not just a number. It is the condensed, emotional, and analytical consensus of millions of decision makers. This means something profound that most investors never stop to consider. Any information that is publicly known, any fear that is widely shared, any optimism that is broadly held, all of it is already embedded in the price. The consensus is always already in the price. This insight is the foundation of second-level thinking. First-level thinking says, the economy is slowing, earnings will fall, this stock is going down, I should sell. Second-level thinking asks, is the market's expectation for this stock already worse than the actual reality? Has the fear already been priced in? Could the consensus actually be wrong? And if it is wrong, in which direction? First-level thinking is the natural language of emotional decision-making. It takes the current feeling of the market, the current consensus, and treats it as truth. Second-level thinking requires a different posture entirely. It requires you to hold two contradictory things simultaneously: the ability to understand how the market feels and the discipline to ask whether how it feels has any connection to what is actually true. Second level thinking is not contrarianism for its own sake. The point is not to reflexively do the opposite of whatever the crowd is doing. The crowd is sometimes right. The consensus sometimes reflects genuine analytical wisdom rather than emotional contagion. The second level thinker does not assume the crowd is wrong. He simply refuses to assume the crowd is right without independently examining the evidence. That distinction sounds small. Over a long investment career, it is enormous. The investors who consistently outperform over long periods are not, in my observation, smarter than everyone else. They are not better at forecasting. They do not have access to superior information. What they have is a different relationship with the emotional signal. They have learned, usually through painful experience, that the signal is unreliable, that the feeling of certainty about the future is, in markets, almost always a warning sign rather than a guide. I want to talk about something now that receives far less attention than it deserves: the role of social pressure in investment decision-making. We are profoundly social animals. The same evolutionary machinery that generates fear of physical threats also generates fear of social exclusion. For most of human history, being cast out from the group was functionally equivalent to death. The social instinct, the desire to be seen as normal, to align with the behavior of those around us, to avoid the shame of being the only one who thinks differently, is not a weakness of character. It is, once again, a survival mechanism applied in entirely the wrong context. In investing, the social pressure manifests as what I would call the herd tax, the invisible cost that most investors pay by following the crowd. Not because following the crowd is analytically justified, but because it is socially comfortable. Think about what it actually means to make a genuinely contrarian investment. Not just contrarian in theory. Anyone can say they are a contrarian, but contrarian in practice at the specific moment when everything in your social environment is screaming at you to do the opposite. When every financial commentator is pessimistic, when your colleagues have sold their equity positions, when the group consensus is that only a fool would be buying in that environment, acting on a different judgment requires you to accept a particular form of social exposure. You are not just risking money. You are risking the social discomfort of being visibly, publicly wrong while everyone around you appears to be right. And here is the darker truth underneath that. In the short run, they may well be right. The consensus can persist long after it becomes analytically unjustifiable. Prices can continue falling long after they have fallen below fair value. An investor can be correct in their analysis and still experience significant losses and social humiliation before the market ultimately confirms their judgment. In my experience, being too early is indistinguishable from being wrong right up until the moment when it is not. The investor who bought into the rubble of 2009 experienced months of continued decline before the turn. The investor who stayed short in 1999 watched the bubble inflate for years before it popped. The discomfort of being early, of appearing wrong while waiting for the market to come to you, is one of the most psychologically corrosive experiences available in the investment world. Most people cannot sustain it. Most people capitulate. And capitulation is how you convert a temporarily uncomfortable position into a permanent loss. This is the third loop of the emotion trap, and I think it is the cruelest: the timing illusion. The belief that you can feel your way toward the right moment, that if you pay close enough attention to your instincts, to the news flow, to the mood of the market, you will somehow sense when the bottom has been reached and it is safe to re-enter. I have never met an investor who has done this successfully with any consistency, and I have met nearly all of them. The research on market timing is remarkably clear and remarkably consistent across every time period and every market that has been studied. The costs of being out of the market, of waiting for the perfect moment to re-enter, are staggering. A significant fraction of total long-term equity returns are concentrated in a small number of trading days. Miss those days because you were sitting in cash, waiting for the fear to subside, and you will have permanently damaged your outcome in ways that no subsequent cleverness can repair. The painful paradox is that those days, the best days in the market, are almost always clustered around the worst days. The violent snapback follows the violent decline. The investor who is most frightened, who has the most reason to be sitting on the sideline, is precisely the investor most likely to miss the recovery. The timing illusion is not a skill problem. It is an emotional problem dressed as a skill problem. And the disguise is convincing enough that most people never see through it. So what is the escape? If the feeling of fear is biologically hardwired, socially reinforced, and operationally disastrous, what is the investor supposed to do? Let me propose what I would call the architect's discipline. The premise is simple. Even if the execution is not the time to make your decisions, is not when you are standing in the middle of the storm, the time to make your decisions is before the storm arrives. A good architect does not redesign the building when the earthquake starts. He builds the structure so that it can survive the earthquake without requiring any real-time intervention. He accepts at the outset that shocks will come, that the ground will move, that nothing about the environment can be controlled. And he designs accordingly, in advance, from a position of calm. This is how I believe investment decisions must be approached. Not as a series of real-time responses to an ever-shifting emotional landscape, but as a pre-committed framework built in periods of calm that is designed to function through periods of chaos. What does this mean in practice? It means that asset allocation decisions, how much of your capital is in equities, in bonds, in alternatives, in cash, should be made based on your actual financial situation, your actual time horizon, and your actual capacity to absorb losses without changing your behavior. Not based on how you feel about the market today, not based on what the headlines say, not based on what the people around you are doing. It means that the rules for when you will buy and when you will sell must be written down in advance and reviewed during periods of calm, not improvised in the heat of panic. It means building enough structural resilience into your portfolio, enough liquidity, enough diversification, enough conservative positioning, so that when volatility arrives, it does not threaten your ability to stay invested. Because the ability to stay invested, to endure the emotional experience of a declining market without making irreversible decisions, is worth more than almost any tactical move you could make. There is a reason that the most successful long-term investors I have observed tend to underperform in the strongest bull markets. Their structures are built for resilience, not for maximum exposure. They accept that cost willingly because they understand what the alternative looks like. They have seen what happens when a portfolio is built purely for performance in a rising market and then encounters a falling one. The gains of the bull market evaporate. The losses of the bear market become permanent. And the investor, having made a series of individually understandable emotional decisions, ends up with an outcome that is structurally indefensible. But the architect's discipline is not only about structure, it is also about diagnosis, about developing what I would call a thermometer for market temperature. In medicine, a fever is not the disease. It is a signal, a diagnostic indicator that tells you something about the underlying condition of the patient. A good physician does not treat the fever as if it were the primary problem. He uses the fever as information, reads it in context, and forms a judgment about what is actually happening inside the body. Market sentiment works the same way. The temperature of the market, the aggregate emotional state of all participants, is diagnostic information. And like a fever, it tells you something, but not what most people think it tells you. High market temperatures, periods of widespread euphoria, surging prices, abundant credit, and rampant speculation do not predict continued gains. In my experience, they predict vulnerability. They tell you that risk appetites have expanded to the point where bad outcomes have become structurally more probable, even if their timing remains unknowable. A market running a high emotional fever is a market that has borrowed heavily from the future. Low market temperatures, periods of pervasive fear, collapsing prices, constrained credit, and widespread capitulation do not predict continued losses. They tell you that risk premiums have expanded, that pessimism is priced in, that the margin of safety available to the patient investor has widened considerably. A market in the grip of despair is a market that has already paid in advance for a great deal of bad news. This is not a precise instrument. I cannot tell you that at a specific temperature the market will rise. Nobody can. But I can tell you that consistently buying in cold markets and consistently reducing exposure in hot ones has a structural logic that pure emotional investing does not. It is not market timing in the conventional sense. It is what I would call orientation, knowing roughly where you are on the emotional spectrum of the cycle and adjusting your posture accordingly. Which brings me to what I consider the deepest principle in all of this, and the one that is hardest to actually execute. The most important question you can ask about any investment is not, is this a good company, or is the economy growing, or what will the market do next year? The most important question is, what is already in the price? What does the current price imply about the future? What expectations are embedded in this number? Because price is the mechanism through which everything else gets converted into an outcome. The best company in the world is a bad investment if you pay too much for it. A struggling company in a difficult industry can be a spectacular investment if you acquire it cheaply enough. Quality alone is never sufficient. Quality must be married to price. And this is where emotion does its most insidious damage. Because when you are frightened, when the market is collapsing and the headlines are catastrophic, the one thing you are almost certainly not doing is calmly assessing what the current price implies about the future. You are reacting to the sensation of falling. You are responding to the sound of the alarm. You are not asking whether the price now reflects reality or has overshot into irrationality. Conversely, when you are confident, when the market is rising and everything feels wonderful, you are almost certainly not asking whether the price has risen past any reasonable estimate of value. You are extrapolating the recent trend. You are assuming the music will keep playing. You are not asking the one question that matters. The emotion trap is, at its core, a trap about price. It makes you willing to pay too much when things feel good. It makes you unwilling to pay even a fair price when things feel bad. And the spread between those two behaviors over a lifetime of investing is the difference between financial security and financial disappointment. There is one more dimension to this that I do not want to leave unaddressed, because I think it is the piece that most investment education completely ignores. It is the question of memory and the way that recent experience distorts our sense of what is normal. Human beings are not equipped to weight the distant past equally with the recent past. We remember vividly what happened last year. We feel it. We remember only abstractly what happened 20 years ago. We know it happened, but we do not feel it the same way. This asymmetry shapes how we estimate probabilities, how we assess risk, and how we form expectations about the future. The investor who experienced the financial crisis of 2008 and 2009 firsthand carries that experience in his body in a way that cannot be replicated by reading about it. And that embodied memory influences his behavior for years, sometimes decades afterward, in ways he is often not fully aware of. This recency bias is another form of the emotion trap. The most recent experience becomes, by default, the most likely future. A long period of low volatility trains investors to treat volatility as abnormal. A severe decline trains investors to treat further decline as the most probable outcome long after the evidence has shifted. We are prisoners of our most recent emotional experience, and the market exploits that imprisonment with extraordinary efficiency. The antidote is historical perspective, not as a source of predictions, but as a corrective for the distortions of recency. When you understand that markets have recovered from every major decline in recorded history, without a single permanent exception, you develop a relationship with decline that is qualitatively different from the relationship formed by recent memory alone. The data does not eliminate fear, but it provides a counterweight. It reminds the nervous system that what feels unprecedented usually is not, and that what feels permanent usually is not either. I want to close with something that I think is important to understand about the nature of emotional discipline in investing. It is not what most people think it is. Most people, when they hear control your emotions, think it means something like stoicism, feeling nothing, becoming a machine, developing a cold indifference to loss and gain. This is not only psychologically unrealistic, it is also, I would argue, not actually desirable. The investors I have most admired over my career were not emotionless. They felt the fear. They felt the pull of the crowd. They experienced the vertigo of holding a position while the market was moving against them. They were human. What distinguished them was not an absence of feeling. It was an understanding of what their feelings meant. They had developed through experience, through study, through painful losses survived, and lessons extracted a meta-awareness. The ability to observe their own emotional state and ask, is this feeling information or noise? Is this fear telling me something true about the world, or is it telling me something true about my nervous system? That distinction, information versus noise, is the entire game, and it cannot be learned theoretically. It can only be learned by doing, by surviving, by losing and recovering, and understanding precisely why you lost and precisely why you recovered. The emotion trap is not escaped once. It is navigated repeatedly in every market cycle, every significant decline, every period of irrational exuberance. The pendulum swings. It will always swing. The human nervous system will always register the motion. The only question that matters in the long run is whether you have built enough structural discipline, enough pre-committed wisdom, enough honest self-knowledge to not confuse the sensation of movement with a reliable signal about direction. Here is what this amounts to, reduced to its skeleton. Do not make permanent decisions about temporary conditions. Do not extrapolate short-term prices into long-term realities. Do not mistake the market's current emotional temperature for a diagnosis of the future. Build your structure before the storm. Know where you stand, even when you cannot know where you are going. And above all else, above all tactical considerations, above all analytical sophistication, protect your ability to stay invested through the inevitable and necessary periods of pain, because those periods are precisely when the long-term returns are being set. There is a comment I want to leave you with, and a challenge. The challenge is this. I want you to think back to the last time you made a financial decision that was primarily emotional. Not the decision you told yourself was rational, the decision underneath. The one driven by what the market felt like, by what the people around you were doing, by the voice that said, this is different, this time things will not recover. Identify that decision, write it down if you have to, understand the mechanism that produced it, not to punish yourself that serves no one, but to recognize the pattern, because the pattern will return. The market will offer you another test, another moment when fear will dress itself up as wisdom and try to talk you into exactly the wrong move. And the only preparation that actually helps is the preparation you do now, in the quiet, before the next storm has arrived. I do not know when the next major decline will come. Nobody does. I do not know whether current prices reflect rational expectations or embedded complacency. What I do know is that markets will continue to oscillate between fear and greed, despair, and euphoria, as they always have and as they always will, because the participants in those markets are human beings. And human beings are not wired for cold calculation in conditions of uncertainty. The cycle is not a flaw in the system. The cycle is the system. And it will keep running as long as human beings are the ones making the decisions. The misidentification loop will fire again. The comfort trap will seduce again. The timing illusion will convince otherwise rational people that this time they can feel their way to the bottom. The herd tax will be collected again from the millions who find safety in numbers and discover, too late, that the crowd was running toward the cliff rather than away from it. But you now have names for these things. And that matters more than it might seem. You cannot defend against a force you cannot see. You cannot override a mechanism you cannot identify. The first and most important act of discipline is simply this: to know the enemy well enough to recognize it when it arrives, wearing the reasonable face of caution, speaking in the calm voice of prudence, telling you that this time, finally, the fear makes sense. The only question is which side of that cycle you will be on when it matters. The pendulum will swing again. It always does. The only edge that endures, the only one that cannot be replicated by an algorithm, cannot be competed away, cannot be bought, is knowing with honesty and precision where you actually stand. That's all. Thanks for watching.